Well, let's go ahead and get started here. And first thing I want to talk about just is the exam and grades and what have you, just so we're all aware. The answers should be open by the end of class, okay? So you can go back, click on it, and find out how well you did, what have you. If there's any errors or any problems, let me know. It just didn't open up until we got started right now in class. So it should be open at the end of class. A couple of quick notes. First off, some of you did really well. Some of you probably wished you had done a lot better. And the first question is there any extra credit? And the answer is no, but, okay. I have extra credit built into the course. If you can turn in all the assignments, what have you, you're going to be able to earn more than the amount of points that I promised you in the course of study, what have you. So there's extra credit built in. There's nothing extra you can do, but there is extra credit built into the course. Okay, right now we're at a total of 160 points approximately. Okay, so we're probably about 160 points. So probably, and just to kind of give you an idea, 140 is probably an A. Okay, somewhere around 125 is probably a B. 110. Say one thing and another thing comes out of my pen. B. 110 is probably a C. Okay, just I'm factoring in some extra credit, what have you. Might be a little bit different than that, but that kind of gives you an idea. I mean, officially, it'd be probably about 155, 140, 125. I mean, those would probably be official 90, 80, 70. No. God, my math. About 145, that's about 15 points, 130, 115, something like that's probably, so somewhere 140, 145 is probably an A, 125, 130 is a B, 110, 115 is bottom C. So those are kind of the ranges we're looking at right now. If you're below 100, okay, you got to kick it up probably a little bit. Turn in all the assignments, what have you, and for going forward, and you should be in pretty good shape. But that kind of gives you an idea on where we stand grade-wise at this point. Any questions? None? Okay. Chapter 4, okay, deals with what we call adjusting entries. Okay, chapter 4 deals with adjusting entries, and there are really just 4. 2 deal with revenue, 2 deal with expenses. And the whole purpose of adjusting entries is to match revenue and expenses. We learned about the matching principle. The whole idea behind these is to match revenue and expenses. Okay. That's the purpose. So if we want to think about it as we're thinking about these, the 2 revenue is 1, we collected the money we need to do the work. Okay, just because we collected the money doesn't make it revenue. So it's a liability until we do the work. Okay. Or we did the work, but we need to bill it. Okay, we did the work, but we need to bill it. Okay. And the way this may come up, just to kind of give you an example, we collected the money, we need to do the work. That's my example from last week, Virginia Tech tickets. They paid the money back in April or whatever, haven't done the work yet. Did the work, but I need to bill it. Suppose I've got a job and I'm painting a house and it's going to go from September, it's a big job, September 21st to October 10th. Okay, it's a big job. Lots of painting to do, what have you. It's September 30th. I paid all my employees. I've been doing that, you know, up to September 30th. I've been paying them, but I'm not billing the job until October 10th. So is it fair that I count all those expenses, but none of the revenue? And the answer is no. Okay, so I need an adjusting entry to account for that. Those are the two big ones on that side of the equation. Typically, adjusting month entries are done at the end of the month. If you've ever talked to an accountant and they go, oh, it's the end of the month, okay, I can't do whatever. The reason is probably because they're working on adjusting entries. Okay, so those are the two for revenue. And then we also have two for expenses. We have one where we paid the bill, but are using the expense over a period of time. Example, car and auto insurance. Most of us pay for 6 months of auto insurance. Well, we pay for 6 months, but then we use it, usually the way to think about it is we usually use it in monthly increments. So auto insurance is where we paid the bill, but we're going to expense it over some period of time. Or two, okay, we owe the money, but there's no bill yet. So those are kind of the two groups, if you will. One's revenue, one's expenses. They're done at the end of the month, okay, or the end of the quarter, or the end of the year. And it's just using the matching principle. We're trying to match revenue and expenses. Questions on any of those?
So is owing the money but no bill yet kind of like a credit card?
It could be, and that would be a good. I'm gonna say yes. Imagine this, okay, and I'm just gonna put some meat onto your example. You use the credit card bill, and the billing period is from the 15th of a month to the 15th of the next month, correct? Something like that. It is now the end of the month. You're going to prepare a balance sheet. You're going to prepare an income statement. You're going to prepare all those things. If you don't include all these expenses, you just haven't matched your revenue and expenses. If you wait for that bill to come, it's too late. And then your balance sheet's going to be wrong for that month or that quarter or that year. Your income statement's going to be wrong. If you're doing taxes on it, your taxes are going to be wrong. Okay, so yeah, that could be, whoops, an example. So with that being said, let's go ahead and take a look at some problems. And the one I'm going to start with is exercise 4.3 on page 173. 4.3. Okay. We paid rent for advanced use of the facilities for the 6-month period from February to July 1st. This payment was initially recorded as prepaid rent. Okay. So we paid money as advance rent, and these are adjusting entries required on May 31st. Okay. In order to kind of explain what's going to go on here, I'm going to show you a little bit more of what's going on here. When I did this, I paid them on February 1st. So my journal entry on February 1st, and this is not an adjusting entry, just so I'm clear. My journal entry on the 1st would have been prepaid rent cash. And for how much? 33 grand. I paid him rent for 6 months. Here it is. And this is the same way auto insurance works. You know, a lot of times if you do a six-month policy. So that's the February 1st. Okay. Now what's going to happen is that 33 grand is for 6 months. So if I take 33 grand and divide it by 6, that means it's $5,500 a month. Okay. Now prepaid rent, just so, okay, is an asset. Okay. In theory, now keep in mind, depending upon the rent agreement, what have you, may not, but in theory, I can go back and say, hey, I don't want the building anymore. Give me back whatever I haven't used. So my rent is $5,500 a month. So every month, February 28th, March, 31st, April 30th, May 31st. I've got to make an adjustment. These are all going to be adjusting entries. And they say to make the payments or make the adjusting entry for May 31st. So we're going to go ahead and do it. Keep in mind, all these would be identical. The June and July one would also be identical. Okay. But what my adjusting entry is going to be is it's going to be rent expense prepaid rent for how much? $5,500. So it's going to be rent expense, prepaid rent. So what I am doing is I am turning an asset, prepaid rent, into an expense. We do this whenever we prepay something. Okay. My auto insurance, prepaid for 6 months. It's going to go into prepaid auto insurance. And then every month, I'm going to turn it into auto insurance expense, auto insurance expense, auto insurance expense, auto insurance expense. I'm going to do it 6 times. When I do it, it's going to, once I do it, let me just kind of, if you think about this prepaid rent, this account, prepaid rent, which is an asset account, starts at 33 grand, goes down every month by $5,500 to 3, 4, 5, 6. And then the value in that prepaid rent is down to 0. What I would probably do, write them another check for 33 grand, use it over the next 6 months. Keep in mind, if I write them a rent check every month, I don't need these adjusting entries. Questions? So that's part 1 of exercise 4.3. Let's do part 2. So that's part 1. And once again, I'm going to give you the journal entry that kicks it off. Okay. And then I am going to give you the adjusting entries. Notice we collected 45 grand from the sale of season tickets for the team's home game. This is my Virginia Tech example. Okay. The entire amount was initially recorded as unearned ticket revenue. During the month of February, the team skated several home events, of which 7,000 became earned. So last time I showed you the, Virginia Tech might do it after every football game. This they're doing it at the end of every month. Okay, that's perfect. So they collected 45,000 in cash. So the original entry was cash went up by 45 grand. And unearned ticket revenue went up by 45 grand. Now, unearned ticket revenue is a liability account. I owe them the games. And if I don't play the games, I got to give them their money back. Okay, so it's a liability. I owe them the games, or I owe them their money back. So now this is a journal entry for May. I don't know why it says for February, for May there, because that's wrong. So this is going to be for February. So this is going to be February 28th. There's an error in the book. Okay, so February 28th, they played some home games. We owe them the money. So it's going to be unearned ticket revenue. And then it will probably be an account like ticket revenue earned. And for how much? 7 grand. And that is turning a liability into revenue. Now, one other quick note about these adjusting entries. You know it's an adjusting entry because one part of the adjusting entry will always be an asset account. Or I should say not an asset account necessarily, a balance sheet account.
Mr. Sass, I have a question.
Yep.
Hey, so when the original journal entry that you have up there, the unearned ticket revenue is a liability.
Yep.
Okay. And then it becomes revenue.
And then it becomes, I owe them the games.
Okay.
Okay. And just think about it. When I do these, I always think about it from Virginia Tech's perspective. They collect money from their season ticket holders in, February or March or whatever for the next football season. It's not fair for them to count that as income. They haven't done that. They haven't played the games. Now in the fall, when they're playing the games, now they can count it as revenue. So that's what it is. It's a liability because they owe the money back. Or they owe the game, I should say. Every adjusting entry will have part of it hit the balance sheet and part of it hit the income statement. Okay. Taking a look at this one. Ticket revenue earned is the income statement. Unearned ticket revenue is the balance sheet. Rent expense is the income statement. Prepaid rent is the balance sheet. They have to impact both the balance sheet and the income statement. Questions? Let's look at some more. Let's do exercise 4 or 5 on page 174. Interest expense is another one that frequently comes up. Okay. And what happens, and this doesn't happen so much for you and I as it does for businesses. Businesses tend to borrow a big amount, maybe 100 grand. And they say, we'll pay you back in 6 months with interest. Okay, so we'll pay you back the 100 grand plus interest in 6 months' time. Banks don't let you and I get away with that, but they do let businesses do those types of things. So what you get here is what's going on in part 1 of this exercise. The company has an outstanding $50,000 9% 2-year note payable issued on July 1st. Payment of the 50 grand note plus all the accrued interest for the 2-year loan period is due in full on June 30th of year 3. So what it says there is to prepare the part A, says the 2 adjusting entries required on December 31st. Okay, so let's go ahead and do the first one there first. Okay, now notice what's going to happen in this case. Let's get it. Sometimes it helps with a little timeline. They've got 50 grand. In their case, it's going to be 50 grand for 2 years. And at the end, they're going to pay back the 50 grand plus interest. Okay. Now, to figure out interest, we take the principal amount now let's just do it this way. The amount times the rate times time. Okay, that is how we figure out the amount, the principal amount borrowed, the amount times the rate times the time. So the amount is 50 grand. The rate, I think, was 9%. Keep in mind that's 0.09. And the way to think about time is a year is a 1. A month is 1/12. It could be quarterly, which should be 1/4. Could be semi-annual, which would be a half. It could be number of days. I mean, you could do it by, I mean, you could do it a whole bunch of different ways. So anytime the time is a year, it'd be 1. If it was 2 years, it'd be 2, what have you. The issue here is we're figuring out the interest monthly to make these adjusting entries. So the time is going to be 1/12. So we've got 50 grand at 9% for 1/12. So that the interest is $375. 50,000 times 0.09 divided by 12. So that makes my journal entry then here. My journal entry will be interest expense, $375, interest payable, $375. The interest expense is my income statement item. The interest payable is my balance sheet item. So I've got one income statement item, one balance sheet item. So I do have a adjusting entry. And what in theory is going on here, once again, I like my timelines, is I'm starting out, I borrowed 50 grand. Every month, I'm going to add $375 to interest payable. At the end of the 2 years, I have to pay them back 50 grand plus $375 a month times 24 months because it's 2 years. Questions? I'm going to do part B that goes with this one right now, and then we'll come back to the second journal entry. So let's go ahead and do part B because part B fits with this, and I've already got the interest figured out. So let's go ahead and see what happens. Notice part B. Assume the 50,000 note payable plus all accrued interest are paid in full on June 30th of year 3. What portion of the interest expense associated with the note will be reported in the firm's year 3 income statement? Okay, well, think about what's going on here. It is June of year 1. And we've got December 31st, year 1, December 31st, year 2, and I'm going to pay it back on May, is it May 31st or June 1st? June 30th. Oh, it was issued on July 1st. Sorry. So I've got June 30th. So here's 12 months. Here's 6 months. Here's 6 months. So that's the way the interest is going to be figured out. So the interest for this period of time is going to be $375 times 6 months. The interest for this period of time will be $375 times 12 months. And the interest for this period of time will be $375 times 6 again. So the question asks, part B asks, assume that it's paid in full on June 30th. What portion of the total interest expense will be reported on the firm's on their income statement? It will be $2,250. How did I get that? 375 times 6. Questions? One other quick note, as long as I'm here, when I go to pay off this loan, what will it look like? Well, keep in mind, we've got $2,250 there, we've got $2,250 there, and we were going to have $4,500 there. Okay, so when I pay this loan off, I am going to have a journal entry that looks like this. It's going to be note payable. $50,000. That pays back the original note. I'm going to have interest payable. It's going to be a total of all those, so it's going to be $9,000. And then it will be cash for $59,000. So when I pay it off in year 3, it'll look like that. Questions? Now let's go back and take a look at 2. The firm provided consulting services to Texas Oil at an agreed upon rate of $1,000 today. At December 31st, 10 days of unbilled consulting service had been provided. This is very common when these types of things come up. You might bill on the 15th, you might bill on the 31st, like, this or what have you. But this is a common occurrence, if you will, in the business world. You've done the work, but you haven't sent them a bill yet. Okay. So what you're going to do is your journal entry is going to be accounts receivable. And it's going to be to consulting fees earned. And it's going to be for a total of $10,000. So it's going to look like that. Okay. Why $10,000? Because we did it for 10 days. It was $1,000 a day. Okay. Now, why might this occur? This might occur in a situation where I bill when I'm done with the project. I bill when I'm done with the project, started the project here in December, but I'm not going to bill till I'm all done sometime in January, which gets me to Part C. Part C says, assume that on January 30th, they received $25,000 in full payment for the consulting services provided in December and January. What portion of the revenue is going to be counted in January? Well, notice what's going to happen. Okay. They're going to pay $30,000. Was it $30,000? Pardon me, $25,000. Okay. They've already counted $10,000 as revenue. So the revenue in January is only going to be $15,000. Okay. Now, when they pay me, it could be done one of 2 ways. I may have then sent them another bill. And so I may have had another bill that had accounts receivable for $15,000, consulting fees earned for $15,000. And then they paid me, so it'd been cash, accounts receivable for $25,000. That is probably the way it was done. But they could have also just walked in and said, hey, how much do I owe you? Handed me a check, and I would have done it a little bit different. But questions? Anybody? The next problem we're going to do is exercise 4.7, which gives us a number of different journal entries. So we're going to do 4.7, and this is still on page 174. So part 1, and the beauty of this assignment is it covers almost all of the types of journal entries we would run into. Okay, cover almost all the types of journal entries that we would run into. So let's, first one, a bank loan was obtained on December 1st. Accrued interest on the loan was $1,500. So in this particular case, we didn't have to figure out the interest. They told us the interest. So the journal entry on December 31st would be interest expense, interest payable. I owe them the money. I'm going to count it as an expense. $1,500. Okay, $1,500. So that's interest expense, interest payable. Once again, interest expense is my income statement item. Interest payable is my balance sheet item. One income statement, one balance sheet. It's an adjusting entry. Question 2, frequently when we buy large ticket items, we buy them, we put them on our balance sheet, and then we depreciate them over some period of time. Okay, we'll talk how do we depreciate things, different things in chapter 8. So we're not going to worry about we've got to figure out the numbers here, but we'll worry about it more, the details, when we get to, I think it's chapter 8. So it says depreciation is based on an estimated life of 30 years. It was purchased 4 years ago for 450 grand. So we've got this December 31st. It was purchased for 450 grand. Okay. It's going to be depreciated over 30 years. So we divide it by 30. Okay. And that'll give us the annual amount, but then we also need to find out 1/12 of it because we're going to be doing this adjusting entry every month. So the amount is going to be $1,250 a month. So our journal entry will be to depreciation expense accumulated depreciation building for $1,250. And once again, income statement item, it's an expense. Accumulated depreciation building. Quick note about that type of an account. That is what we call a contra asset account. Okay. It's an asset account, but with a funny balance. It's going to have a credit balance. Okay. So it's going to work to push down the value of that building. Okay. So that's an accumulated depreciation. It's a contra asset account. And that was question 2. Questions so far? Question 3. Accrued but unbilled revenue during December amounts to 75 grand. What that means is I did the work, but I haven't billed it yet. I did the work, but I haven't billed it yet. So that's going to be accounts receivable. Okay, accounts receivable, marketing revenue earned. That was for 75 grand. Accounts receivable is my balance sheet item. Marketing revenue earned is my income statement item. Questions? Part 4. On March 1st, the firm paid $2,400 to renew a 12-month insurance policy. The entire amount was recorded as prepaid insurance. So we bought a 12-month insurance policy, and every month we're going to use up 1/12 of it. Okay, so we've got insurance expense. No, let's keep it. Insurance expense, prepaid insurance. Now the question is how much? Well, we bought this policy for $2,400. It's good for 12 months, so I'm going to divide it by 12. So it's going to be $200 a month. And my insurance expense is my income statement item. My prepaid insurance is my balance sheet item. Journal entry 5. It's also December 31st. Firm received 15 grand in advance of developing a 6-month marketing campaign. It's kind of like a deposit, folks. They put down a deposit. Okay. So the way to think about it is they put down a deposit. So what they have is unearned revenue. So the journal entry will be unearned revenue. And then it will be what marketing revenue earned, marketing revenue earned. So they put down a deposit, and they did some of the work now. So they've earned it. How much did they earn? They earned 9 grand. Okay, 9 grand had actually been earned. So there's that. Unearned revenue is my balance sheet item. Marketing revenue earned is my income statement item. One quick note, when they originally paid when they put down the deposit, okay, The way it would have looked is the deposit was cash. It was what, 25 grand? 15 grand. Cash would have gone up by 15 grand, and their unearned revenue would have gone up by 15 grand. That green one is not a adjusting entry, but that's how it would have been recorded originally. Questions?
So in this one, 6 grand is just kind of floating around there.
6 grand. Yes. Okay. What happened is I owed them 15 grand to work when they gave me the deposit for 15 grand. Okay. I've so far worked off 9 grand, so I still owe them 6 grand to work. So there's still 6 grand in that unearned revenue account. Any other questions? Last one. Let's give myself a little more room here. Is salaries expense. We'll talk about salaries a little bit more also, I think chapter 10. But we had some employees that did some work. They pay their employees on Friday. Since December 31st fell on Wednesday, there's accrued liability for salaries to amount for 12/9. So it's December 31st. I'm not going to pay them till Friday, but I mean, it's Wednesday. I'm putting together a balance sheet, putting together an income statement, going to report to that. I got to show everybody, you know, what I've paid them, what have you. So my journal entry will be salaries expense. Salaries payable. I owe them the money for $1,900. And once again, salaries expense is my income statement item. Salaries payable is my balance sheet item. It is an adjusting entry. And one quick note, when I pay them at the end of the week. So the end of the week will be January 2nd. I'm going to write them a check. What's that journal entry going to look like? I'm going to have salaries payable for how much? That $1,900. I'm going to have what I owe them for the last 2 days of work. So salaries expense. I'm just going to make up a number here, about 900, 950, I guess. That'd be half. It's probably, oh well, doesn't matter. In cash, $2,850. So when I actually pay them on January 2nd, salaries payable takes care of Monday through Wednesday. Salaries expense takes care of Thursday and Friday. And my cash goes down by the $2,850. Questions? Part B says, what is the impact of these? And this is just at the very top of page 175 there. By how much did they increase or decrease their net income? What we need to do is we need to just go through and, take a look at all my journal entries here. Interest expense. So that's 1,500. 1,250. $75 grand. Insurance expense, 200. $9,000. So if I sum up those red numbers, whoops, that'll get me there. So if I sum all those up, I had two positive amounts. I had 75 grand plus 9 grand, total of 84. And then my expenses, I had 1,500 plus 1,250 plus 200 plus 1,900. So those are my revenue items. Those are my expense items, those four. I think there were 4, 1, 2, 3, 4, yep. Okay, and let's see if I can do those in my head here. It's 50. If I make a mistake, let me know. 9, 11, 13, 18. 2, 3, 4. So I have to subtract my expenses of 84.50. So I get 79,150. So how much did those adjusting entries change my net income? It changed my net income by 79,150 bucks. Questions? Anybody? Let's do exercise 4.8. And this is on the top of page 175. This just gives us some practice, if you will, working on interest and how it's calculated, how it works, what have you. Notice what we have here. The Jesse Company adjusts its accounts monthly, which is pretty common, okay? And closes its accounts on December 31st. We'll talk about closing next week in chapter 5, okay? On October 1st, they signed a note payable. They borrowed 150 grand from the bank for a period of 6 months, annual interest of 6%. Part A, what is the total interest expense over the life of the note? So was this part 1 or part A? Part A. What was the interest expense over the life of the note? Well, we take the principal amount, how much we borrowed, which was 150 grand. We multiply it by the rate, which is 6%. Then we multiply it by the time, and the time was 6 months. Okay, so it's 6/12 or a half. Keep in mind, you can always, simplify it, if you will. So the total interest for the 6 months is 4,500 bucks. We can also then figure out the monthly. Does it ask us for the monthly here? How much is the monthly? Yep. How much is the monthly interest expense? Well, it's 4,500 for the total amount. If we divide it by 6, because we have 6 months, okay, it'll be $750 per month. Part B, if the company's annual balance sheet in December, what is the amount of the liability to the bank? Well, we own the loan of 150 grand, plus we owe them interest. And so the question is, how much interest Well, we borrowed the money on October 31st. So we owe them interest for November and December. So we owe them 2 months at $750 a piece. So we owe them $1,500 in interest. So we owe them $151,500. Questions so far? Part C. Prepare the journal entry to record the issuance of the note payable on October 31st. So October 31st, they gave us cash, gave us, really not true, but we'll go with it. They lent us 150 grand, so our cash went up by 150 grand and our notes payable went up by 150 grand. So that's C. D. What's the adjusting entry on December 31st? Well, on December 31st, our adjusting entry, it's going to be for $750. We already did that. It's going to be interest expense. Interest payable. Questions? Part E asks, what is the liability to the bank on March 31st? Well, we owe them the 150 grand. We owe them interest for November, December, January, February, and March. So we owe them 5 months. It's $750 a month. So that's $3,750. So we owe them $153,750. Questions? Anybody? Last one, as you all know, is my favorite, exercise 4.2. Oops. We're going backwards here a little bit. We're on page 173. This is my favorite, increase, decrease, no effect. And so they're going to have income statement over here. We're going to have balance sheet over here. And we're going to have revenue minus expenses equals net income. And assets minus liabilities equals owner's equity. They do it that way or the other way. That way. I'm going to do it a different way. Assets equal liabilities. plus owner's equity. Part A, they gave us, so I'm gonna just kind of cheat, if you will, or what have you, copy it down and then show you what the journal entry looks like. And then we'll proceed to the other ones. No effect, increase, decrease. Increase, decrease. When net income goes down, owner's equity goes down, so that's a decrease. Decrease, no effect. Let's just look at what that journal entry is. Depreciation expense for November. The journal entry would have been depreciation expense, accumulated depreciation. Depreciation expense is my expenses. Accumulated depreciation, remember that's a contra asset account, goes to reduce my assets, is my decrease. So that's why that one makes sense. So now that they haven't given them to us, let's go ahead and we're going to do this like last time. I'll do the journal entry and then I'll let you help me through the rest. Interest expense has accrued for the month of November. So we've got interest expense. So let's see what we get here. B, interest expense. So it's going to be interest expense, interest payable. That's what my journal entry is going to look like. So somebody want to guide me through my increase, decrease, no effect based on that journal entry? No brave souls?
Okay, I'll try it.
Doesn't hurt, Carolyn.
The interest expense would decrease revenue.
We're either are, let's kind of just walk through it here, Carolyn. Are
Okay.
either of these accounts revenue accounts?
No,
So it has no effect on revenue then, does it?
no,
Are either of these accounts expense accounts?
yes,
Which one? Okay, so we've got interest expense, it's debited. So when we debit an expense account, does that make it go increase or decrease?
decrease. No, increase, I'm sorry.
You're fine. You're fine. Whenever expenses, I mean, and keep in mind, this is how you learn, this is how you get practice. This is how you learn, Carolyn, you're helping, all you're doing is helping yourself. Okay. Expenses are almost always debits and they're almost always going up. Revenue is almost always credits and revenue is also almost always going up. Okay. We'll talk about return. We'll talk about return, how to handle returns and stuff like that. But for the most part, the way to think about it is those, expenses are always debits, revenue are always credits. When in doubt, do that. 99% of the time, you're going to be correct.
Okay.
So if revenue didn't change and expenses went up, what happens to net income?
It's going to increase. No,
It's going to decrease, right? Our expenses went up. Our revenue didn't
decrease.
change. Okay, so it's going to decrease. Now, 99% of the time when net income goes down, what happens to owner's equity?
The
It
same
goes
thing.
down.
It goes down. Okay, so that's going to go down. So now I've got this interest payable. Is that an asset account or a liability account?
It's a liability account.
Pardon me?
It's a liability account.
It's a liability account, correct? And we're making that liability, we owe them the money, so that liability is going to go up or down.
Up.
So liabilities are going to increase. So liabilities increased, owner's equity decreased. So and none of those accounts were asset accounts, so it has no effect. Makes sense? So let's go on to C. See what happened here. Revenue earned during November has not been billed yet. Okay, so it hasn't been billed yet. So we're going to have something like accounts receivable. Revenue earned. It's going to look something like that. So do I have any brave souls out there?
I'll try it.
Go for it, Forrest.
So your revenue is going to increase because you
revenue's
just
gonna-
earned revenue.
Yep,
No effect on your expenses,
bingo,
and therefore your net income is going to increase.
bingo.
You got an accounts receivable, so your assets is going to increase.
Yep,
Your revenue, your liabilities is going to have no effect,
yep,
and then your owner's equity is going to increase.
yep. Perfect. And notice once again, and I mean, the only thing that doesn't work this way is dividends, but net income and owner's equity almost always goes the same direction. Perfect. Questions on that? Let's continue on with D. And salaries payable have been accrued since the last payday in November. So what I'm going to have is I'm going to have something like this: salaries expense. They've worked, but I haven't paid them yet. Salaries payable. So that's going to be my journal entry. So, any other brave souls?
I'll try.
Perfect. Go ahead, Courtney.
Your salaries expense goes up.
Correct.
So that makes your expenses go up. It's not showing any revenue, so that's no effect. Net income is no effect or decrease.
Yep.
Your assets is no effect.
Yep.
Your liabilities goes up,
I owe them the money, so it goes up. Perfect.
and your owner's equity decreases.
Bingo. Not so bad, right, Courtney?
No,
It's more scary to talk than it is to actually, So yeah, when you look at the journal entries, a lot of times the journal entries will point you in exactly the right direction. So E, portion of the company's prepaid insurance has expired during November. So I'm going to have something that looks like insurance expense. Prepaid insurance. So that's what my journal entry is going to look like. Any brave souls? Anybody?
All right, I'll try it again.
Doesn't hurt. Carolyn, it won't hurt. I promise.
All right, so it has no effect on your revenue.
Yep.
Your expenses increases.
Yep.
The income decreases.
Yep.
It's an asset. No, there's no.
Prepaid
It's nothing to
insurance
do with the asset.
is an asset that you use up. So it is an asset that you use up because you put the entire 6 months of premium in there and then you pull it out as you need it, so to speak.
All right, so that would have no effect, correct?
It go down because I'm crediting when I credit an asset, it's going to go down.
And then the liability will increase.
Nope, liability is going to have there's no liability there. The insurance expense is over there. The prepaid insurance is
Oh,
there.
it's expired. Okay,
Yep.
gotcha.
And so my owner's equity goes
Down.
down. Quick note, and I used to be in the insurance industry, and just like, you're paying your 6 months premium, it's unfair for me to count that as all revenue because I haven't earned it yet. And so I earn some of that revenue every month. So when I was in insurance, every month I earned a little bit of your insurance. Just like every month you're counting a little bit of it as an expense. Every month I was earning a little bit as I was providing you with insurance for that month. So it's kind of just the other side of the journal entry, if you will. And the last one, let's see what the last one is. Earned a portion of the amount collected in advance from a customer. Okay, so I collected some money in advance. Okay, so what my journal entry is going to be is it's going to be unearned revenue. Revenue earned. So that's what that journal entry is going to look like. I earned a portion of an amount that they paid in advance. So I'm earning a portion of what I collected in advance. I did the work now, what have you. So last one, folks, come on. Give Carolyn a break.
Can I give it another shot?
You sure can. Go for it, Forrest.
All right, so you're earning revenue, so your revenue is going to increase.
Yep.
There's going to be no effect on your expenses, and therefore your net income is going to increase.
Bingo.
There's going to be no effect on your expenses.
We already said that. Yep.
Your liability is going to decrease.
Oh, assets. You meant assets.
Assets, yeah.
I'm sorry. Your liabilities are going to decrease. Why are your liabilities going down?
Because your unearned revenue, you've earned some of that unearned revenue.
Bingo. So your liability is going down. You don't owe them as much work anymore. Perfect. Thank you.
Yep. And then your owner's equity is going to increase.
Bingo. Okay. Once again, I mean, if you're getting these, it means you have a good handle for what's going on. If you're struggling a bit with these, which is why I'm kind of, letting you, kind of struggle through these and not just going through them, that means you're struggling a little bit more with the concepts. So this is, if you're able to follow along with what we're doing here, you're probably in pretty good shape. If you're struggling with these, you probably have to spend a little bit more time and a little bit more work on it. Any questions? If not, folks, the exam should be open so you can take a look at it. If you have any questions or issues, please let me know. I was looking at them today. Most of them are pretty good. There's a couple of you that did not do well. But if you have questions, please let me know. And they should be open so you can see the answers. For next week, it'll be Chapter 4 assignment, Chapter 5 Learn Smart. I believe I've already got that set up, so it's ready to go. And I will see you next week.
Can I stay over for a minute?
Yep.